Good morning and welcome to the Killik & Co market update. It's been another fairly quiet week in the market. Equity indices have remained at levels around their all-time highs, and certainly on the face of it, volatility has been somewhat muted. In fact, the S&P 500 has now gone 13 days without moving more than 1% in either direction, which is the longest stint since January last year. A quick look at equity markets on a year-to-date basis. We can see that Europe has been performing particularly well. A lot of that is due to what's being termed as the reopening and reflation trade, which basically means that there's been a reallocation of capital to parts of the market that have been somewhat suppressed in recent years as investors have favoured higher growth US equities and technology companies in particular. Interestingly, the European auto sector has put in a strong performance. It's up 28% on a year-to-date basis, and that's in spite of the supply issues that they've been seeing as a result of the global shortage of semiconductors. The top performers in the sectors have been Porsche and Volkswagen, and they're up 72 and 51% year-to-date respectively, and that's not, of course, forgetting that Porsche, in fact, owns just over 50% of the ordinary shares of Volkswagen. Now, I mentioned a moment ago the US and tech supremacy that we've seen in recent years, and it's something that we can see really clearly in this chart, which shows the 5-year price return for the same markets we looked at previously side by side. The tech-based NASDAQ really has been a force to be reckoned with, up 215%, and the broader-based S&P 500 up 104%. Against that, European indices have been clear laggards. We saw US inflation data for May yesterday, and it'd be fair to say that the market had been in somewhat of a holding pattern in anticipation of its release. The year-on-year figure came in at 5% versus an expectation of 4.6%, and this was the largest 12-month increase since a 5.4% rise in August 2008. Equity futures initially sold off but recovered their poison in fairly short order, and the S&P went on to print an all-time high. We saw the US 10-year bond yield spike up to 1.53% initially, but they were back down below 1.5% within the hour. And when we look at the components that make up the headline numbers, we can see that a fair amount of the largest increases are coming from components associated with post-pandemic reopening, things like used car and car hire prices, for example. So this perhaps plays into the favour of those calling for the inflationary pressures we've been seeing to be transitory in nature. So the market will now look forward to next week and any potential discussions in the US with regards to the timing of Fed tapering. And tapering basically means the Federal Reserve reducing its monthly bond purchases, which in turn reduces the amount of stimulus it's providing to markets. So US inflation slightly higher than expected, but markets seemed happy to shrug it off for the time being. Cornwall is, of course, hosting G7 leaders this weekend. The G7 includes the UK, US, Canada, Japan, France, Germany and Italy, and some EU representatives will be there also. As ever, there'll be plenty to discuss. Key themes will likely include more collaborative approaches in controlling COVID-19 and fighting global climate change, and no doubt the thornier issues of Russia and China relations will crop up, as well as Brexit and corporation tax. I, for one, am hopeful that they'll be able to keep it civil and maintain relations over an ice cream or two, but we'll hear more over the weekend. And again, a fairly quiet corporate calendar next week, but we'll be keeping an eye out for Ashtead and Tesco in particular. That's all from us this week. Have a great weekend, and Rachel will be back again next Friday.